Good morning, everyone. You are watching a live daily market outlook for Tuesday, 15th of January 2013, prepared by Windsor Brokers. Yesterday's major event speech of Mr. Ben Bernanke, the president of Federal Reserves, did not bring much results into the markets, as basically the Fed chief provided no signals for the further for the quantitative easing expiration, and basically it just spoke about some other things, other issues in the markets. As we said, the comments from Bernanke, he provided no signals of quantitative easing expiration, and basically he focused on two main issues: the long-run sustainability of US debt and the fragile recovery. The Bernanke said that federal budget must be brought under control, warning that plans to adjust the budget should be carefully well thought in order to avoid pushing the economy into the recession. He also commented that U.S. economy is not out of the woods, with improved optimism after the fiscal cliff deal that eliminated a good bit of the restrictive components, and some modest improvements seen in the jobs market. But of course, the stronger numbers in the economy and the labor market are required to signal some stronger recovery of the U.S. economy. The Bernanke, with regards to the number of tools available to stimulate the economy, Bernanke said the Fed is not out of ammunition, adding that judging by the reaction of markets since the establishment of the first quantitative easing program, Bernanke said overall QE has succeeded in reducing long-term rates, and Fed have found QE to be an effective tool. Also, the Bernanke said it's early to determine the effect of asset purchases, suggesting the extension of quantitative easing in the near term seems a done deal, while waiting further proofs, especially in the labor market, to determine length of the quantitative easing extension. While growth has been moderate, the housing sector has shown positive signs. Bernanke said for the first time since 2006-2007, there is sustained increase in home prices, which should help U.S. economy through the year. Bernanke said the Fed's policy unlikely to create overinflation, adding that small changes in interest rates will not make much difference for the economy as a whole, but low inflation and high unemployment makes the case for aggressive monetary policy. The Fed chairman continues to monitor the closely costs and risks of easing policy, and he remains worried on the cost of high unemployment, saying a main effort should be aimed at fueling economic strength for a better labor market. On global growth, Bernanke sees it somewhat slower, while highlighting that emerging markets fundamentals are pretty good for now. The Bernanke speech could be summarized as the Fed has done its fair part, and now it's turn on Congress to roll the sleeves and pitch in to theirs. From the markets, Euro remains in a sideways consolidative mode versus the US dollar after posting yesterday a fresh 11-month high at 134.00, with the still holding above important 133 support. Basically, the range floor at 133 so far holds the downside. Cable regained some ground after yesterday's sharp fall that hit 160.30, with the subsequent bounce higher still unable to regain 162.00. That keeps the downside vulnerable. Of course, regarding the cable, a bunch of you had UK data, and the speech of Bank of England's Governor Mervyn King due at 10 o'clock GMT are in the main focus. Japanese yen rebounds from its fresh 2.5-year low against the US dollar, correcting the recent strong rally, and the pullback has accelerated on the comments of Japanese economics Minister Amari that excessive yen weakness could have a negative impact on the country. And that was all from the highlights for today. We're going to take a look on the calendar that is quite busy today. We have a number of events. Mainly their data, the prevailing data from UK and the US, with the German monthly inflation for December being released already and came along with expectations and the previous release at 0.9%. Data from UK start at 9:30 GMT, where we have CPI and the PPI as well as retail price index, and of course the speech of Bank of England Governor King at 10 o'clock GMT. Home price index for December is forecasted at 1.7% versus 1.6% in November. CPI is unchanged, expected unchanged at 2.7 in the December, for 2.7%, pardon, in December, as well as core CPI for December at 2.6. Producer price index input is forecasted at 0% versus 0.1% in the month of November, and the output is at again at 0% compared to minus 0.2% release in the month of November. Retail price index for November is forecasted at 3.1, slightly above the November's release at 3%, while leading index for December we have now forecast minus 0.4% is the previous release. US and Bank of England Governor Mervyn King is due to have speech at 10 o'clock. At the same time, we have European Eurozone trade balance for November. Forecast shows widening the surplus to 8.2 billion euros compared to 7.9 billion euros release of month of October. And that will conclude the European part of the economic indicators. No other things to be released until America starts, and immediate releases are from United States, and again a number of indicators due to be released today. Retail sales for December from US at 13:30 GMT. Forecast is slightly below the previous release of November, that was 0.3%. Today's consensus 0.2%. Core retail sales are expected to tick higher by 0.2% compared to 0% in the month of November. Producer price index 0.2% forecast versus 0.3% November's release, and the core PPI at 0.3% versus 0.1% in the November. At the same time is Empire State Manufacturing Index for January. That is forecasted still in the negative zone, but forecasted to improve to minus 0.99 compared to minus 8.1 in the month of December. Business inventories for November due at 1500 GMT. 0.3% is forecast compared to 0.4% October's release, and basically that will be the highlights of the economic indicators due to be released today. We're going to move now to the technical part. Meantime, you can prepare questions if you have any questions and suggestions to be submitted at the end of the session. Technicals start with the euro. As we can see on the hourly chart, the pair is in the sideways consolidative mode. 133.30 approximately and the 134 are the range limits, with the positive tone still prevailing despite descending indicators on the 1 hour chart. Still positive sentiment sees the upside firmly in the focus, but a break above 134 is required to resume the broader bulls. On the 4 hour chart, quite extended conditions on all indicators still did not produce any firm signal of some stronger reversal, as the previous highs and the strong support zone at 133 stays intact for now. Basically the price action holds above yesterday's low at 133.35. That marks the near term consolidative range floor, and so far it's being contained there ahead of 133 previous strong barrier, now acting as support, reinforced by ascending 20 days exponential moving average. And basically ideally any dips should be contained around this zone in order to keep recovery of 130.00 in play for possible extension higher. with the daily structure still holding a quite positive tone and keeping it upside favored, especially that the pair surpassed important 133 barrier and ticked the next psychological resistance at 134. Yesterday on the upside, we are looking for on a clear break above 134. We'll be looking for test of 134.85. This is February 2012 yearly high. The yearly high of 2012 posted in February, and this also marks approximately 50% retracement of the longer term descent from 149.38 down to 120.42, and just above this at 135.26 is the weekly 200 days moving average. Basically, these are the upside targets. As said, dips should be ideally contained somewhere at or around the 133 zone in order to keep immediate bulls in play for a fresh attack and a possible break above 134. That will open 134.80, 90, 135 as the next upside targets, while any slide below, I would say quite important support higher platform at 132.47, reinforced by 38.2% retracement of the upleg from 129.96 to 134.02 would delay immediate bulls and allow for some stronger corrective action. British pound is still under pressure despite some recovery action seen of yesterday's low at 160.30 as the pair failed last Friday at 161.77, an acceleration of losses seen on a break below 161 that dipped so far to 160.30, bringing again near-term focus down to the very strong support and base at 160 area. Subsequent corrective action of 160.30, yesterday's high, so far reached 160.93, but again failed to regain important 162 psychological 162 barrier, 161 barrier that marks approximately 50% retracement of the down leg from 161.77 to 160.30, and basically the losses, the gains were capped by descending hourly 55 days exponential moving average so far. Unless we see a break above 161, and not much to be expected from the current recovery. Yes, negative tone still dominates on the hourly chart, and basically break above 161 and 161.20, that marks approximately 61.8% retracement, would shift focus higher again and prevent the pair of revisiting important 160.30 and more significant 160.00, 159.90 supports. For our structure is at this point again losing traction as MACD is now slightly below its midline, and RSI and the momentum 14 are below their 7 days moving averages. That overall will with price holding below 20 and the 55 days moving averages, which gives overall a negative tone so far, and sees more risk towards the downside with the retest of initial support yesterday's low at 160.30, seen preceding slide towards very strong 159.90, 160.00 support area, loss of which is expected to open a fresh leg lower as a part of the broader reversal from 163.80 peak of 2nd of January and the year-to-date high at posted on 2nd of January 2012, with the break below 159.90 to open 76.4% and the low of 28th of November at 159.60, and then comes 159.00 round figure support, and the 200 days moving average quite strong support area. On the upside, as we said, lift clear break above 161 is to provide near-term relief and allow for some stronger corrective action. Still break above 161.41 and 161.77 as key near-term barriers is required to open way for a stronger recovery and confirm again base at 160.00 for a possible test of 162. That is seen as the next strong barrier in case of clearing last Friday's peak at 161.77. Dollar yen is in the corrective mode with the losses accelerating, as we said on the comments of Japanese economic minister, that some more serious and stronger steps should be taken in order to prevent further weakness of Japanese currency. So far, the pair dipped to approximately 288.62 exactly. This is the low since far on the pullback from 84.66, and it's nearly a 38.2% retracement of the upleg from 86.81 low of 9th of January to 2.5 year fresh high at 89.66 posted yesterday. The hourly structure is still in the negative territory and sees potential for a further easing as the 10 days exponential moving average crosses now. Already crossed below 20 days one and now crosses below the 55 days one, offering a quite good barrier at 89 zone, our initial resistance, with penetration through 89.00 again required to shift the focus slightly higher and for possible renewed attempt towards 89.66, with yesterday's rejection seen at 89.62 that prompted the fall down to 88.62 so far. 4-hour structure shows the indicators now emerging off the overbought zone that gives a signal for some stronger corrective action, especially that the price dented the 20 days exponential moving average currently at 88.60, 88.93, pardon, that starts to move sideways. That is another signal for possible stronger reversal with 88.40 previous high seen as the next downside target ahead of 88.00 round figure reinforced by 55 days exponential moving average. Ideally, any stronger dips should be contained at or above 88.00 in order to keep the immediate bullish structure in play for a possible repeated attempt at 89.66. That will open 90.00 as our next upside target. Only slide below 86.81 low of 9th of January. This is also close to 38.2% retracement of the larger 81.71 to 89.66 rally would sideline basically bulls and allow for a stronger corrective action of the broader rally from September's low at 77.12 that so far peaked at 89.66. Also overextended the daily studies, yet not producing any reversal. The signal warn of possible stronger corrective action, although the overbought conditions persisted in the past couple of days, but no significant pullback has been seen despite overextended conditions. Now its main focus is on the Bank of Japan's meeting that is due next week, in 1 week time, approximately 21st and 22nd of January, when there will be a monetary policy decision, especially with the number of comments being released past couple of days showing a readiness of Japanese officials to take some stronger measures in order to prevent further sliding of the Japanese currency. And dollar Swiss is in the recovery mode after again finding support at a strong support zone at 91.00. We have base at 90.80 and 91.00 where the recent dips from last Friday and yesterday found support, and subsequent stronger rally seen yesterday retraced over 76.4% of the down leg from 93.02 to 91.09, shifting the near-term focus towards the upper boundaries as a good part of the rally of the fall has been erased. Our structure is in the positive territory. Over both conditions have already produced pullback down to 92.20. It's important that the price will remain above psychological 92 support. This is also marking a 38.2% retracement of the upleg from 91.09 to 92.60, and ideal point is seen around this zone for any stronger dip reversal in order to keep upside in focus for test of the next barriers 92.72, and more significant is 93.02, high of 4th of January 2012. That will confirm the base at 98. Yes, shown on the daily chart. We can see that the pair is attempting again through the main bear trend line drawn of 99.70 2012 high. Several attempts so far failed with the descending with the bear trend line now still defining the overall downtrend as the pair stays, the price action holds below this trend line. Any break here and the more significant 93 that is reinforced by 50% retracement of the larger down move from 95.11 to 90.77, and also the 55 days moving average. A break above 93 is to confirm the near-term base and allow for the stronger recovery, especially that higher low attempt to post the higher low at 91.09 is now underway, with the break above minimum 92.72 and basically more significant 93.00 required to confirm it, and open way for stronger recovery of the larger downtrend. Ascending indicators on the daily chart with the fresh bullish momentum seen building up. See potential for a possible fresh strength and the break above these levels. Currently we have at 92.63 is the trend line resistance, break of which to focus 92.72 and 93.02 as our key near-term barrier, and the break point on the downside. Loss of 92.00, that is as we said 38.2%. Will face 91.91, that reinforces basically the 92 figure support. 91.91 is the ascending 55 days hourly exponential moving average ahead of 91.84, 50% retracement. Loss of higher platform at 91.66, that also marks 61.8% retracement, would sideline bulls and bring bears back in play for possible renewed attempt down towards 91.00 and 90.80 base. Crude oil remains steady, still unable to regain the previous high at 94.68, but the near-term tone is still aligned towards the upside as a series of higher lows of last Friday's low at 92.64 with subsequent one at 92.94 and overnight one seen at 93.71, still keeping the upside more in focus. 4-hour structure holds a positive tone, I would say rather in the sideways mode so far, but holding above 20 days moving averages initial dynamic support, and a more significant ascending 4-hour 55 days exponential moving average at 93.00 that defines the current slope and current ascent. Keeps focus at the upper boundaries 94.25 and more significant is 94.68 high of last Thursday, 10th of January, break of which to signal resumption of the broader recovery from 84.05 low of 7th of November and the higher low at 85.20 posted on 11th of December 2012, with the structure being supported by positive tone on the daily studies. On the downside, as we said, 90 immediate support 93.70, then 92.94 and 92.64 higher base. Basically break below this level could be quite risky, as it will risk now return to the support at 91.52 low 4th of January and the 200 days moving average currently at 91.19, loss of which is to revive bulls. So far, as we said, the overall picture remains still aligned towards the upside and keeps the upside favored for now, with the fundamentals also so far being well supportive for the energy prices. And finally, the yellow metal remains in the corrective mode, especially in this morning's fresh strength higher that reached 1683. Basically, we surpassed our initial barrier at 78. This is better seen on the 4-hour chart, retracing now, breaking above 76.4% retracement than the previous high, as the trend line resistance has also been cleared at 1670, opening way towards 1694. This is the previous high of 2nd of January, as well as 1700 round figure resistance, a break of which is seen as a trigger for some stronger recovery, and to signal base at 1625 for upside extension towards 100% Fibonacci expansion of the upwave from 1625, where is also the larger bear trend line drawn of yearly peak of 2012 at 1795, currently standing at the same level. So approximately 1709 is acting as a strong resistance, and our next upside target after a possible clearance of 1694 and the 1700 is set. Positive tone in the near term picture keeps the upside focus, and we're looking now for test of 1694 and 1700 as our initial supports. Bullish crossover of 20 over 55 days moving averages at approximately 1664 underpins the action, as ascending 20 days exponential moving average currently at 6068, maintaining the current rally. Focus again at the upside, immediate support at 1664, ahead of a more significant at 1650 zone. Basically only loss of 1650 zone could risk further reversal, but for now break above the trend line and the previous high sees more focus and more possibilities of retesting 1694 and 1700 as our next upside targets. And that will be all from my side for today's presentation. Please, as I said at the beginning, if you have any questions or comments, please you can submit them right now. No questions? Good. Then thank you all for being with us. We expect to see you again tomorrow morning, which will be Wednesday, 16th of January 2013, and our next session will start at 8 o'clock GMT, 10 o'clock local Cyprus time. Meantime, through your trading platform, you will receive a number of technical analysis. The one for currencies has already gone. We're now preparing the commodities, and the same thing will repeat in the afternoon. All those that connected later can find today's daily market outlook in the YouTube. Our page is called Windsor Brokers Forex. Until tomorrow, I wish you a nice day, and as always, very good and successful trading. Good luck.